Look at a stock that just popped nearly 21% in a single day.
Mm.
I mean, is this the beginning of a massive turnaround for an undervalued pioneer? Or is it the ultimate value trap waiting to crush retail traders?
It is the ultimate question in the market right now, honestly. And, just to be clear with everyone listening, our goal today is purely educational. We are unpacking the market mechanics and looking at the raw data, but we aren't here to give you financial advice.
Right, absolutely not.
You always have to make your own calls on where to put your money.
Exactly. We are just here to figure out the how and the why. Because if you look at the calendar today, it is April 15th, 2026.
Yep.
And Beyond Meat, trading under the ticker BYND, just closed the trading session at 75 cents.
Which is a huge jump.
Right. That is a massive 20.97% gain in a single day. And, the financial news is attributing this spike to a nationwide product rollout. But a single-day pop doesn't just erase years of history.
No, it definitely doesn't.
So we need to look at their latest financials, the technical signals on the charts, and the insider order flow to figure out what is actually happening beneath the surface of today's hype.
Okay, let's unpack this. Going from a high-flying market darling to trading for pennies is quite the fall from grace.
To say the least, yeah.
Can their fundamental financial foundation actually support a sustained rally?
Well, to answer that, we have to look past the visceral excitement of a 21% daily gain and face the sober, cold reality of their annual numbers.
Okay, lay at me.
If you open up their full year 2025 income statement, the picture is incredibly bleak. Their annual revenue came in at $275.5 million.
Okay.
And that is down roughly 15% year over year compared to 2024. But it's the bottom line that really, really hurts. Their trailing 12-month diluted earnings per share sits at negative 1.83.
Wait, negative 1.83 on a stock trading at 75 cents.
Yeah.
That is an incredibly heavy burden. But hold on, I'm looking at their net income line for the year, and it actually shows a positive gain.
I know. It says they had a net income of $178.01 million. How is that mathematically possible? How can revenue be down 15%, earnings per share be deeply negative, but the net income line is flashing green?
This is where we run into some serious accounting magic.
Oh, boy.
That positive net income is a massive optical illusion. Yes, they recorded a one-time gain of $178.01 million, but that money didn't come from selling plant-based burgers or striking new distribution deals.
Right.
It came entirely from a $548.7 million non-cash debt restructuring.
Okay, break the mechanics of that down for the listener, because non-cash debt restructuring sounds like Wall Street jargon for, moving numbers on a spreadsheet without actually putting a dollar in the bank.
That is essentially what it is. Look, when a company is in deep distress, creditors will sometimes agree to take a haircut on the debt owed to them.
Meaning they agree to accept less money than originally promised?
Exactly, simply because taking a partial loss is better than the company going bankrupt and them getting absolutely nothing.
Yeah.
So when Beyond Meat renegotiated this massive debt load, accounting rules dictate that the forgiven or restructured amount gets recorded as a gain on the income statement. It looks like profit on paper.
Wait, so they recorded a gain on paper just by moving debt around while their actual operations are bleeding cash?
Yes.
That's like me selling my car to pay my mortgage and bragging to you that my bank account looks great this month.
That is the perfect analogy. You temporarily solved a balance sheet problem, but you still don't have a job paying your daily living expenses.
Wow.
If you strip away that paper gain and look at their operational reality, the actual cash they generate versus the cash they burn to keep the lights on, they posted a brutal EBITDA loss of $194.55 million. Their core business model is currently bleeding out.
Which brings us to the balance sheet. We have a company losing nearly $200 million operationally. I'm looking at the heavy baggage they are carrying, and the numbers are just staggering.
They really are.
Total debt currently sits at $1.2 billion. Against that mountain of debt, their total cash on hand is just $203.89 million.
Barely a drop in the bucket.
And with a trailing 12-month free cash flow of negative $58.1 million, that cash runway is vanishing quickly. But the metric that really stops me in my tracks is their shareholder equity. It is sitting at negative $784.1 million.
Yeah, that negative equity figure is the glaring siren for anyone paying attention. It indicates technical insolvency.
Meaning, if Beyond Meat liquidated everything, tomorrow they sold their factories, their proprietary IP, their inventory, everything, they would still be nearly $800 million short of paying back their bondholders and creditors.
Correct. The shareholders would get absolutely wiped out. They would see zero return. And that fundamental collapse is entirely reflected in the historical stock price. Just look at their 52-week range. They have fallen from a high of 7.69.
It is effectively a graveyard, and they are drowning in over $1 billion of debt with negative equity. This morning's 21% rally makes zero fundamental sense.
None whatsoever.
That means we aren't looking at investors buying a company. We're looking at traders trading a chart. So let's push directly into the technical analysis. What are the trend lines actually telling them?
Well, we have to separate the short-term market mechanics from the overarching long-term trends. The long-term trend for Beyond Meat is still severely bearish.
Okay.
The stock is trapped in a multi-year falling trend channel. Every time it tries to rally on a piece of news, it hits a ceiling of selling pressure that ultimately pushes it to new, lower lows.
I'm looking at the moving averages, and I see a spark of life, but it feels deceptive.
It is.
Thanks to today's POC to 75 cents, the stock is currently trading above its 20-day and 50-day simple moving averages. But both of those lines are still declining. And more importantly, the stock remains buried well below its 200-day SMA.
Yeah, watching these short-term moving averages tick upward today is like watching someone rearrange deck chairs on the Titanic. The 20-day trend looks nice, but the 200-day trend, the ship itself, is already underwater.
That's a great way to visualize it. And if you look closely at the momentum indicators, they back up that skepticism.
What do you see there?
Yeah, I ran the numbers on their momentum indicators, and they are completely contradicting this 21% pop. The RSI is stuck at 54.7. For a stock that just exploded over 20% in a single session, you'd expect momentum indicators to be flashing deep into overbought territory.
Right.
But 54.7 is dead neutral, and the MACD is barely registering at 0.009. If this were a true violent breakout, those would be flashing red hot. It feels like a total fake out.
It does. The MCD at 0.009 suggests only the weakest whisper of a positive trend in the near term. So if we map out the immediate battlefield for the next few trading sessions, the support is sitting right at 72 cents.
Okay.
If it breaks below that level, the ultimate floor is that 52-week low down at 50 cents. On the upside, there is immediate resistance right above today's price at 73 cents and 77 cents.
But those resistance lines at 73 and 77 cents are just minor skirmishes, right? The true wall this stock has to climb is the massive psychological and regulatory resistance at $1.
Right.
Because sitting underneath all of this technical jargon is a looming Nasdaq delisting warning.
Exactly. The Nasdaq exchange has strict compliance rules. You have to maintain a minimum bid price of $1 per share.
Right.
If a stock trades below $1 for 30 consecutive business days, the exchange issues a deficiency notice, which Beyond Meat is currently battling. From there, the clock is ticking.
And if they can't organically push the price back over $1 and hold it there, they get relegated to the over-the-counter penny stock markets.
And that is the death knell for institutional investment. Mutual funds, pension funds, and large asset managers have strict internal mandates that legally prohibit them from buying over-the-counter penny stocks.
Oh, wow.
Yeah, if Beyond Meat gets delisted from the Nasdaq, they lose access to the deepest pools of capital in the world.
So what does this all mean? Are these short-term indicators just a heartbeat on a flatlining patient? If they can't cross that $1 threshold, does any of this chart momentum actually matter?
In the grand scheme of things, yes, it's just a heartbeat. Chart momentum below $1 for a company facing imminent delisting is largely just noise. The structural threat of losing their Nasdaq listing and being cut off from institutional capital completely overshadows a crossover on a 20-day moving average.
Which brings us to a really fascinating behavioral question. With delisting hanging over their heads, a massive $1 regulatory wall to climb, and a business model burning through cash, who is actually putting their money on the line?
That's the million-dollar question.
Let's look at the analyst ratings. Do any of the pros on Wall Street see a turnaround here?
The consensus rating from Wall Street analysts is definitively a sell. If you break down the percentages, it paints a very clear picture of institutional sentiment.
Let's hear it.
0% of analysts rate it a strong buy. 0% rated a buy. 40% have a hold rating. Another 40% say sell. And 20% are screaming strong sell. Furthermore, the median price target from these analysts is 70 cents.
Wow. So even after today's massive pop to 75 cents, Wall Street's median target implies a 7% downside just to get back to their baseline expectations.
Exactly.
But what about the insiders? The people actually steering the ship.
Mm.
If the stock is this cheap, shouldn't the executives be buying up shares to signal confidence to the market?
You would hope to see that, but there are zero recent institutional or insider buy signals. None. When we look at the insider trades, they are purely defensive. The most recent transactions on record occurred on March 2, 2026. CEO Ethan Brown and CFO Lubi Kutua automatically sold approximately $21,000 worth of shares combined.
But I mean, to be fair to the executive, those weren't active panic decisions to dump stock, right?
No, we have to be clear about the mechanics here. Those were automatic sell orders triggered solely to cover the tax liabilities associated with the vesting of restricted stock units. It's a standard corporate procedure.
Right.
But the glaring takeaway isn't that they are actively dumping, it's that they absolutely aren't buying.
So the executives aren't buying, the institutions are barred from buying or choosing not to, and the analysts are telling everyone to sell. If the smart money is completely absent, who caused the stock to pop 21% today? It has to be retail traders.
Yep.
Everyday people firing up their brokerage apps.
The volume and speculation we saw today are almost entirely retail-driven. And what's fascinating here is the behavioral economics behind why retail traders consistently get trapped in these specific scenarios. They suffer from a cognitive flaw known as anchoring bias.
Anchoring bias, meaning they remember when Beyond Meat was a revolutionary culture-shifting market darling, trading at over $200 a share. So they look at their app, see it trading at 75 cents, and their brain automatically anchors to that $200 historical high and screams, it's on an incredible discount. It's fundamentally undervalued.
Yes, and that cognitive trap is incredibly dangerous. Because they see the discount, but they don't see the dilution. They completely ignore the massive share dilution that has quietly occurred over the years as the company issued more stock to survive. They ignore the crippling $1.2 billion in debt, and they ignore the reality of that negative shareholder equity we discussed. It is the textbook definition of a value trap. It looks cheap on the surface, but it's cheap for a very structural, fatal reason.
But wait, let's take that a step further, because there's one piece of the puzzle we haven't discussed yet, and it is highly explosive.
Oh, yeah.
A lot of institutional money isn't just ignoring this stock, they are actively, aggressively betting against it. I'm looking at the short interest data from March 31st, 2026, and it is sitting at an extraordinarily high 31.7% of the float. That is 141.7 million shares sold short.
This raises the most volatile dynamic in the entire analysis. What happens when a trade gets entirely too crowded?
Right.
Shorting a stock means an institution borrows shares, sells them at the current price, and hopes the price drops so they can buy them back cheaper, return the borrowed shares, and pocket the difference.
D6 shorting.
But when 31.7% of all available shares are currently held short, the market becomes a powder keg.
And the days to cover metric is sitting at 5.25. Break down the math of that metric for the listener, because that is the actual spark that ignites a short squeeze.
Right, so days to cover is a calculation of how many days it would take for all the short sellers to buy back their borrowed shares, assuming the stock traded at its average daily volume. At 5.25 days, there's a massive multi-day backlog of short sellers who would need to hit the buy button if this trade suddenly turned against them.
So let's map out that panic scenario. A piece of unexpected positive news breaks like today's product rollout. Retail traders start buying. The stock price starts to tick upward.
And the moment it ticks upward, those short sellers start taking theoretical losses. If the price rises fast enough, their prime brokers issue margin calls demanding more collateral.
Oh, wow.
If they don't have the collateral, panic sets in, and they are forced to rush the market and buy back the stock at whatever price they can get to close out their positions.
And all that forced institutional buying pressure sends the stock price skyrocketing even faster, which triggers even more margin calls and panic from other short sellers higher up the chain. It becomes a violent self-feeding loop.
Exactly. The short sellers are literally forced to become the biggest buyers.
So synthesizing all of that, that 21% pop today might have absolutely nothing to do with fundamental belief in the company's future or retail traders loving a new product line.
Nope.
It could simply be a mechanical market reaction, a mini short squeeze. Short sellers scrambling for the exits because the trade got too crowded.
That is highly likely. It's a mechanical shift in supply and demand, not a fundamental shift in corporate value.
Okay, so knowing we have this absolute powder keg of short interest, combined with those grim fundamental financials, what are the actual best and worst case scenarios for the listener to watch for? Let's map out the outlook. What is going to happen in the short term?
In the short term, over the next few weeks, Expect extreme, unpredictable volatility. You have unanchored retail speculation colliding head-on with massive institutional short interest.
Yeah.
The main catalyst to watch for is the upcoming earnings date on May 6, 2026. Earnings reports for heavily shorted penny stocks are wildly unstable events. A slight beat on revenue, even a minor one, could trigger a massive short squeeze, while a miss on their cash burn could send it tumbling straight through that 50-cent support floor.
And what about the medium-term strategy? Because the executives aren't blind. They know they are facing Nasdaq delisting. They know the balance sheet is effectively insolvent. What is management actually doing to try and save the ship before it goes under?
Well, they are attempting a desperate total brand pivot. They are trying to rebrand the entire identity of the company from Beyond Meat, which carries a lot of cultural baggage right now, to Beyond the Plant Protein Company.
Okay.
This involves expanding entirely outside of the meat substitute aisle. They are pushing into the beverage space with a new line called BYND Immerse, and they are heavily marketing their clean label Beyond 4 line.
I mean, the clean label push makes sense.
Yeah.
They're trying to appeal to the health-conscious consumers who initially loved the idea of plant-based meat, but eventually got turned off by the incredibly long, highly processed ingredient lists of the original burgers.
Precisely. They are trying to solve their fundamental demand problem. But as we discussed earlier, none of this consumer rebranding matters if they lose their major exchange listing, which is why their immediate structural survival hinges entirely on executing a reverse stock split.
Okay, explain the mechanics of that, because retail traders often misunderstand reverse splits as a bullish event when the price suddenly shoots up on their screen.
A reverse split is purely mathematical. It doesn't change the underlying value of the company 1 single cent. Imagine a 1-for-10 reverse split.
Right.
If you owned 10 shares of Beyond Meat at 75 cents, your broker would automatically consolidate them. You would suddenly own just 1 share, but that 1 share would be priced at $7.50.
So it's an accounting trick to instantly force the stock price over the $1 threshold to regain Nasdaq compliance and keep the institutional money from being legally forced to sell.
Yes. But historically, the broader market views a reverse split as a sign of extreme terminal weakness. The underlying fundamentals haven't changed, the debt is still there, and the operational cash burn is still there. More often than not, a stock that executes a reverse split to survive simply resumes its downward trajectory shortly after the split takes effect.
So let's lay out the final scenarios. What is the ultimate bear case here? If this doesn't work, what does the end look like?
The bear case is a relentless continuation lower, driven by macro trends that Beyond Meat cannot control. The reality is that we are witnessing a secular, multi-year decline in consumer demand for plant-based meats.
The novelty wore off.
Exactly. The novelty wore off. And amid persistent inflation, the premium pricing of these products became unjustifiable for the average grocery shopper. If you combine that shrinking total addressable market with a crushing $1.2 billion debt load, negative equity, and persistent cash burn, the bear case leads directly to a very real potential for a 2027 bankruptcy restructuring.
Here's where it gets really interesting, though. Because there is always a bull case, right?
Sure.
No matter how toxic the balance sheet looks, the market absolutely loves a comeback story. So what does the miracle recovery scenario actually look like?
The bull case hinges on a sequence of low probability but high impact events. First, they need an engineered massive short squeeze going into earnings that drives the price up violently. Crucially, management would have to use that temporary inflated price window to issue millions of new shares to the public, raising desperate capital to pay down that $1.2 billion debt.
That would dilute the existing retail shareholders even further, but it would save the company from bankruptcy.
Exactly. Second, the fundamental bull case requires that the new clean label Beyond 4 products and the beverage expansion actually resonate with consumers and completely reverse the multi-year sales slump, generating positive free cash flow.
And there's a third option, right? The white knight scenario, the buyout.
That is arguably the most realistic bull case. Despite the stock's absolute collapse, Beyond Meat's intellectual property, their manufacturing infrastructure, and their brand name are still globally recognized. A legacy food giant, someone with massive, highly optimized global supply chains, might swoop in, buy out the company for pennies on the dollar, absorb the debt, and integrate the Beyond brand into their existing distribution networks where they can instantly make it profitable.
So to synthesize all of this, looking at Beyond Meat today feels like a brutal masterclass in the difference between having a great revolutionary original product idea and having a sustainable business model.
Yeah, that's exactly what it is.
They created an entire category. They completely changed the way the world talked about protein and climate impact. But the short-term reality for this stock offers immense, dangerous volatility fueled by short sellers and retail traders. And the long-term outlook requires a near-miraculous operational turnaround or a buyout from a much bigger fish just to avoid total collapse.
It perfectly illustrates the harshest lesson in business. Being a pioneer doesn't guarantee you will be the one who ultimately profits from the frontier you opened. The unforgiving mechanics of debt, cash flow, and market sentiment eventually catch up with every revolutionary idea.
It makes you wonder, when a revolutionary category-creating company falls this far, this fast, is it a failure of the company's management and structure? Or is it a broader warning that consumer culture simply wasn't ready to change its fundamental habits? If Beyond Meat doesn't survive, who gets to define the future of food?